Did you know that you might be one decision away from becoming an investment genius? Imagine sitting on your couch, eating popcorn, and discovering the secret that Warren Buffett learned from a book. Yes, that book is The Intelligent Investor by Benjamin Graham, and today I will reveal the method that could change your financial life forever. So don't move, because you're about to discover the key to making money like never before. 1. Safety first. Let's get straight to the point. Graham's first principle is safety. No, we're not talking about seat belts or motorcycle helmets. We're talking about protecting your money like it's the last slice of pizza at a party. The key here is to invest in solid companies with a proven track record. Imagine deciding to invest in a tech company that nobody has heard of. No, that's not a good idea. It's better to invest in a company with a proven track record like Apple or Coca-Cola. These companies have a history of success and are less likely to collapse overnight. Why is safety so important? Think of your investments like a castle. You don't want to build your castle on quicksand, right? You need a solid foundation, and that's what reputable companies with strong fundamentals offer you. Before investing, research the company. Read their financial reports, analyze their track record, and make sure they have a lasting competitive advantage. 2. The margin of safety. Graham introduces the concept of the margin of safety, which basically means buying stocks for less than their intrinsic value. Imagine you're in a clothing store and you see jeans that normally cost $100 and they're on sale for $50. That's a margin of safety. Suppose a stock is worth $100 according to your calculations, but the market is selling it for $70. You're buying at a 30% discount, giving you a cushion for potential calculation errors or market downturns. The margin of safety protects you from mistakes and market volatility. It's like having a parachute when you jump out of a plane. Even if something goes wrong, you have a safety net. Always buy stocks with a margin of safety. This not only minimizes your risks, but also maximizes your profit opportunities. 3. The investor versus speculation. Graham differentiates between investors and speculators. Speculators are like gamblers in a casino, always looking for the next big break. Investors, on the other hand, are more like farmers, planting seeds and patiently waiting for the harvest. Imagine your friend who is always chasing the next big cryptocurrency. One day he's euphoric because he's made a bit of money, and the next he's depressed because he's lost everything. Now imagine another friend who has been investing in an index fund for 10 years and sees his investment grow steadily. Being an investor gives you peace of mind and financial stability. You are not at the mercy of daily market fluctuations, but benefit from long-term growth. Stop trying to guess the market. Instead, invest in solid assets and let your money grow over time. 4. Intrinsic value. The concept of intrinsic value is fundamental in intelligent investing. It is the true value of a company based on its fundamentals and not its current market price. Think of a classic car. The market might undervalue it because it looks old, but if you know it's a rare model in good condition, you understand its intrinsic value is much higher. Intrinsic value helps you see beyond market noise. It allows you to identify opportunities where others only see risk. Learn to calculate intrinsic value. This will give you a competitive edge and allow you to make more informed investments. 5. Diversification. Graham also emphasizes the importance of diversification. Don't put all your eggs in one basket. Diversification reduces risk and increases your chances of success. Suppose you only invest in tech stocks. If the tech sector crashes, your entire portfolio will suffer. But if you also have investments in real estate, healthcare, and consumer goods, your losses will be minimized. Diversification is like a tasting menu. You don't know which dish you'll like the most, but by trying a bit of everything, you increase your chances of enjoying the meal. Spread your investments across different sectors and types of assets. This will protect you against market fluctuations and give you more stability. 6. Patience. Patience is a virtue, especially in investing. The best investments often take time to bear fruit, but when they do, the reward is significant. Warren Buffett didn't become a millionaire overnight. It took decades of smart investing and patience to accumulate his wealth. Patience allows you to harness the power of compound interest and long-term growth. Don't worry about daily fluctuations. Keep your focus on the horizon. Don't get swayed by market panic or euphoria. Stay calm and let your investments grow over time. 7. In-depth research. Benjamin Graham insisted on in-depth research before making any investment. It's not just about looking at charts or listening to rumors, but truly understanding what you're investing in. If you're considering investing in a solar energy company, don't just look at its stock price. Research its revenues, expenses, competition, sector trends, and technological innovations. In-depth research gives you a clear vision and helps you make informed decisions. It's like being a financial detective, looking for clues that lead you to success. Take the time to research before investing. Read financial reports, follow industry news, and consult experts if necessary. 8. Discipline. Discipline is crucial on the investment path. You need to follow your plan and not be swayed by emotions or trends. If you have a long-term investment plan, but everyone around you is buying a particular stock because it's trendy, resist the temptation. Stay firm in your strategy. Discipline protects you from impulsive decisions that can be costly. It helps you stay on course even when the market is chaotic. Create an investment plan and follow it with determination. Don't let market noise divert you from your path. 9. Learn from mistakes. Everyone makes mistakes, even the most experienced investors. The key is to learn from them and not repeat them. If you invest in a company that seems promising but then realize you didn't do enough research and lose money, take note of what went wrong and adjust your approach for the future. Learning from mistakes makes you a smarter and more resilient investor. Every mistake is a valuable lesson that brings you closer to success. Don't punish yourself for mistakes, use them as a learning tool. Reflect on what went wrong and how you can improve. 10. Stay informed. The world of investments is constantly changing. Stay informed about market trends, economic news, and technological innovations. Suppose you invest in technology. If you stay informed about new trends like artificial intelligence and blockchain, you'll be able to make better decisions and seize emerging opportunities. Being well-informed gives you a competitive edge and helps you adapt to market changes. It's like having an updated GPS that guides you along the right path. Take time to read financial news, follow investment blogs, and participate in discussion forums. From safety and the margin of safety to patience and in-depth research, these principles will guide you to financial success. Remember, the key is to invest wisely and not be swayed by market emotions. Now, go out and start building your financial future with confidence. And don't forget to leave your comments and like the video. That would help me a lot.